Welcome, everybody, to House Views. I'd like to start with a brief introduction to Hodes Weill. Doug, welcome to House Views. Can you help us all understand who started the business and why? And
Sure,
who are you in business to serve, and what types of assignments do you typically take on?
sure. Thank you, Jeff, for having me today. Um, Appreciate the opportunity. And of course, that's my dog in the background, so hopefully that doesn't bother anybody. So we started, I'd say David Hodes and I, the other founding partner of Hodes Weill, we started working together in 2000, along with a third partner, Bill Thompson, originally at DLJ, where we started a fundraising business for real estate. And then DLJ was acquired by Credit Suisse. And we continued to run that business until 2009, when David and I saw an opportunity to strike out on our own. And so we set up the firm that we have today. Today, we're just shy of 40 people on the platform, and we've really expanded from real estate placement to cover real estate infrastructure and other real assets. And also, we've become much more global, and we've been active on the advisory side, which was really the advisory business was one of the reasons we wanted to leave Credit Suisse. Is we were finding that there was more opportunity to do more with our clients, the general partners, and they were at the time in '09 encountering distress and uh, um, situations where they had to navigate restructurings. And so we started off doing some restructuring work that expanded to strategic advisory work, and then continuation vehicles and recaps. Although when we were first working on them, we didn't call them continuation vehicles. And then manager related M&A, which is a big trend in the industry. And we're one of the most active advisors to managers on strategic transactions. So our clients are the managers, but we also look at ourselves as intermediaries, also serving the institutions, limited partners, and consultants, trying to select the best opportunities to work on, making sure they're structured properly, and then hopefully making everyone's job easier when they're underwriting or diligencing an investment opportunity. And that's really our role in the market at the end of the day. I think we're, one of the most active global firms doing what we do. And we're now in business as Hodes Weill in, I guess, going into our 17th year.
Yeah. Now, um, with almost 40 professionals out in the field talking to people every day, you guys get a different viewpoint, which is why we're doing these. We're trying to tap into people that are really seeing the broad market. So can you give us a brief recap of 2025 market performance? Was it as challenging an environment in 2025 as a lot of us felt it was? And if so, why do you think that was?
Yeah. Look, I think directionally 2025 um, felt better in terms of capital formation. It was an uneven year. We started the year with a lot more momentum. And then in April, Liberation Day, that really cooled the market for at least 3 or 4 months. And then we saw activity, engagement with LPs really pick up in the fall of 2025. Um, we look at 2025, both from an industry standpoint and our business, as feeling a little bit like 2022 in reverse, in that in 2022, the market started off strong and then cooled down. In 25, with the exception of Liberation Day, started with good momentum, but built throughout the year. And that felt good. It felt good. Now we're still, that's an improvement off of a very low base. The 23 and 24 capital formation years were very, very challenging. Capital raised was down. The time it took to raise capital probably doubled for managers in the market. The market was dominated even more so by the large cap and mega cap managers. and the capital was predominantly re-ups. So you could look at the statistics as to how much fundraising was down, call it 60% off the peak being 2021. And that sounds bad in itself, but at that, about 80% of the capital was re-ups. So not a lot of new money available for new strategies. And that made it increasingly challenging in the market. But as I said, 2025 felt better. The year was a good bounce back year, and we're hoping that momentum continues into 2026.
Now, you guys have offices in the US and Europe and in the Asia Pacific region. What was the capital flow activity in those regions? Where was the money coming from? You say a lot of it was re-ups, but how active were European investors, Asia Pacific investors versus US investors during that period of time?
Um, I think it really depends on the region and even at that, the country. I'd say broadly, and Jeff, I think you're aware we release every year an allocations monitor study we do with Cornell. And what the report shows and what we've seen and what we're hearing from institutions is that their portfolios have shifted to being underallocated to real estate, and that was a big shift. And it's a combination of public equities doing what they've done, performing really well, so denominator effect, but also numerator. We went through 7 or 8 quarters of write downs in real estate, and we could probably have a whole separate podcast on whether the write downs were sufficient to represent what's happened in the market. But that said, 7 or 8 quarters of write downs and denominators growing, and institutions went from being meaningfully over allocated to under allocated. And that was at the same time that sentiment started to improve. And you're clearly hearing it from the big managers out there, the GPs that are have called the bottom and are increasingly optimistic about the opportunity to deploy capital. And that sentiment is also consistent with institutions. And so, again, the combination of institutions having capital now and sentiment growing is what's driving the market. It does depend kind of market to market and by type of institution. I'd say that the U.S. institutions are probably the fastest to come back to the market, but the European institutions are increasingly active, and we're seeing a lot more flows now out of Asia as institutions are increasingly active, including out of South Korea and Japan, are two markets that I would highlight.
Now, for a while, managers are pretty slow, not only to write down, but also to call capital. And so there was a lot of dry powder that built up. Is that getting dissipated? Are people transacting business at a more rapid rate today?
That is so. Dry powder is coming down. It had peaked by some measures at over 500 billion, and maybe that's down by half. So combination of new investments and then also capital being deployed to existing portfolio investments, and and um, and so dry powder has come down, and so that's an important consideration for institutions who are looking at their dry powder. And that was something we were hearing from institutions the past couple of years, that while they were seeing a good opportunity and a couple of good vintage years ahead, they also had a lot of dry powder and they didn't feel like they were going to miss the market. But as that capital is drawn, as some funds are timing out where their investment periods are ending and maybe not getting extended, that dry powder is drawing down.
So, you've alluded to this a little bit, but could you give us a clear picture of what your overall outlook for 2026 is?
Um, Look, it's a very volatile market. Assuming we don't have any significant headlines, and that's obviously hard to predict. But directionally, we feel good coming into the year. The past few weeks, if it's indicative of the market, the engagement with institutions has been quite strong, and we believe that institutions are going to be more active this year. So I think it'll be a good step up from 2025, which was a very good bounce back from 23 and 24, but remains to be seen. Again, it's a volatile market. It also depends on the type of strategy, right? Not every strategy is going to clear the market, but there is capital out there for the right strategies and the teams that have demonstrated good performance and can differentiate themselves in the market.
So what are some of the right strategies in this kind of market? What kind of strategies are most likely to resonate with investors based on your ongoing conversations with members of the investment community?
It's a good question. I think there's a little bit of a barbell in a sense that there is, from a risk return standpoint, um, demand for high return strategies. Let's start with return profile. So value add and opportunistic is still the preference for most institutions. So value add and opportunistic funds are better positioned. But we are seeing some signals that the appetite for um, probably core plus more than core is coming back. We've seen some of the consultants that are increasingly constructive on that risk profile. And while the open-end funds, which are predominantly focused on core and to a certain extent core plus, are still contending with significant exit queues, there are signs those queues are beginning to lighten up, that some redemptions requests have been rescinded. There's a little bit of inflow. There's some secondary trading, and these are all pretty good signs for the market. Plus, the valuers are indicating that they've kind of hit bottom on their valuations and their cap rates that they're using. So those are all pretty good signals. So I would say predominantly focused on higher return versus core plus, but some pretty good signals that the appetite's coming back for core plus. In terms of strategies, um, I think there's pretty good demand for diversified value add and opportunistic today in a market where there's still reasonable uncertainty, and institutions would rather the manager make that decision as to where to put the capital. In strategies like office, I think you know, there's some growing interest in office. I think most institutions would rather get that through their opportunity fund or value add fund than maybe do a direct um, strategy focused on office, but that could change. Um, and um, and there's interest in some of the sectors that have good tailwinds. So we're seeing continued demand for industrial strategies, um, from big box to shallow bay, um, and last mile, um, and other storage related strategies are of interest. And the demand for multifamily appears to be coming back, um, as supply is, the overhang of new supply seems to be burning off. The fundamentals seem to be firming up, and I think the sentiment is growing for multifamily. And then some of the niche strategies are still in demand, like iOS and data centers. If we want to categorize data centers as real estate, are still of of interest to institutions. Although the market, I would say, is a little bit overwhelmed with a lot of investment strategies that are raising money right now.
You painted a nice picture of what's going on in real estate investors' minds. What about infrastructure investors? Because you're also working in that field. What
Right.
is the risk appetite, and what are the particular types of infrastructure that are attracting most attention right now?
Yeah. Um, the excuse me. Yeah, the dynamics in infrastructure are much different than real estate. First, I would point out that, and we've reported on this, that infrastructure and real estate are increasingly adjacent strategies, if not converging. And we're seeing that both in the way institutions allocate to real estate and infrastructure, in many cases, beginning to combine the strategy into one overall allocation of of real assets. And we're seeing managers that are either moving from real estate into infra or infra into real estate, and large cap managers that are combining their real estate and infra into a real assets division. So the convergence is happening, and I think we'll continue to see that. The dynamic in infrastructure is, I would say, a bit more favorable from a capital flow standpoint, more than a bit, I'd say meaningfully better. And we also release a report on allocations we do with Cornell. We're in the market with that survey right now. Institutions are significantly underallocated. They're still building their portfolios. The average allocation is about, just call it about 5% to infra. In real estate, it's 10 to 11. So call it between the two, 15%. Infra allocations, target allocations are growing faster, and institutions are earlier in the build out of their portfolios, particularly institutions in the United States. I'd say the demand for within infrastructure is probably, most focused on digital today. That's where we're seeing a good portion of the demand.
And we've also heard that there's a big demand for private credit across the spectrum. Are you seeing real estate debt funds still getting traction, or is the bloom off that rose?
Um, I think the headlines for real estate credit have been more favorable than the capital flows have actually been over the past few years. I think the interest in credit on the real estate side has been for slightly higher return strategies. Most of the strategies and funds today are kind of gross 10 to 12, net 8, 9 returns. And that has been a little low for most institutions over the past few years. And also in particular relative to private credit, private equity credit, where the return profile is higher. And we can make the argument all day long that real estate credit is asset-based lending and private equity is corporate lending, unsecured, but that really doesn't, really carry the day. The institutions have been favoring private credit versus private real estate credit. Um, I think that's shifting, and you're seeing demand come back to that return profile, just as we're seeing demand come back for core and core plus. Um, it's been about 25% of the fundraising volume over the past 5+ years. But if you kind of look through, it's been particularly challenging for that return profile in the market over the past few years.
Now, you mentioned, Doug, earlier that investors are moving more towards value add and opportunistic strategies. What's their thinking behind that shift in perspective?
I think there's a view that the market's been beat down, number one. Number two, there has been an expectation that there be more distress in the market, if not dislocation. And we're seeing that episodically. And I think it always takes a few years for the distress to really materialize. And we're starting to see some pretty interesting transactions in the market. I think that's part of it. I think also in an uncertain market, where there are just so many cross currents, having the manager pick and choose the right sectors and geographies is of more value to some institutions. Now, I would point out that not every opportunity fund and value add fund manager is having an easy raise. No one's having an easy raise, or maybe a few managers out there, but very few. I would point out that the market there really seems to be a separation going on in the industry, where some of the perennial fundraisers on the opportunistic and value add side have now had multiple funds that have underperformed, and importantly have not returned capital at a DPI level that is that warrants another fundraise, or an institution committing a follow-on capital investment. So we are seeing kind of a separation in the market right now, and I think that will be exacerbated over the next couple of years. At the same time, there's some new managers that are actually coming to market, some portfolio teams that have left, pretty reputable firms and have set up their new businesses and are raising money at reasonable scale, which I think is really healthy for the industry. So this kind of cycling, or we've referred to it as falling stars, is a dynamic that I think we'll see, more and more play out over the coming years.
And what about the age-old debate over which is a better vehicle for institutional investing? We've been hearing this for years, private real estate investment programs or publicly traded REITs. What's your view on that?
Well, I do have a strong view. We put a paper out a couple of months ago, which seemed to get a lot of airtime. The key point we were making, and I used to be a REIT banker, so I understand, I think, that side of the industry. I think REITs and private are very complementary for institutions, but can play very different roles. I think REITs are a great substitute for core plus for institutions. I think there are certain strategies that are very hard to access on the private side that are well capitalized on the public side. And increasingly, we're starting to see institutions allocate to securities out of their private allocation, out of their real estate allocation. The point in the paper that we were making is, if you're going to invest in private funds and you are taking lockup risk, so you're not getting the same liquidity for sure, and you're taking presumably more risk because they're typically higher leveraged, and investing in assets that require more turnaround or redevelopment risk than you would see in the REIT market. Are you getting the alpha? Are you getting the outperformance? And I think if you can pick managers in the first couple of quartiles, the outperformance is very substantial. And so the point we were making is, you shouldn't do private funds versus REITs. You should have both in your portfolio because they're very complementary and they serve different purposes. But over the long term, they sit well side by side and provide a balanced allocation to real estate.
Okay, so I'd like to end with a question kind of borrowed from the movie City Slickers. If there was just one thing you'd recommend our viewers take away from this discussion, what would it be?
Related to real estate, right?
Yeah, or
Stick to the script. Yes. Um, Look, I think real estate is a long-term investment strategy. There are times in the market to be more of a trader, but that is, not the typical market. The wealth in real estate is made in longer term holds and over time. And so real estate should play an important role in institutional portfolios, and for that matter, in private investor portfolios. And having a well balanced portfolio that addresses your objectives from a liquidity and a risk and return profile can be very complementary in an overall diversified portfolio. So real estate's had its reset, I think, and the next couple of years could be really good vintage years. And every time we've come out of a downturn, those couple of years, the performance has been, really outsized. And again, it's not about timing or trading the market, but this is a really good entry point, or I think it's a really good entry point over the next couple of years.
okay. Well, listen, thank you for doing this today. We really appreciate it. We look forward to what Hodes Weill has to say in our next quarterly installment of House Views. And we really appreciate the role that Hodes Weill has been playing as a leader in the business. You add a lot. You do things you don't have to do, like your surveys and things of that nature. And it really has an impact. So thank you for your leadership role.
Thank you, Jeff. Appreciate being included and also the kind words and also the role that you play in the industry. It's tremendous. So thank you for including me.
You betcha. Take care.